Hey everybody, welcome back to my channel. Today I want to talk about a case study where I walk you through a long-term purchase using a DSCR loan. So DSCR loans stand for debt service coverage ratio, and it is an excellent way for real estate investors to build their rental portfolio. There's basically three gotchas with a DSCR loan. You have to have the necessary credit score, you have to have the necessary assets, and the property has to cash flow at some level. So we'll touch on these as well as we go through this, but that's the big three. Now, this is a case study. So this is a hypothetical purchase of a property in Chicago. It's a 3-unit or a 3-flat, as they call it there. So this is going to change depending on where you are in the country. Just kind of take these as a guide for how this strategy works and how you can use it to amass quite a bit of real estate. Now, in this example, this property is listed for $450,000. It's got 3 units. Each unit rents for $1,600 a month. So it's very evenly divided. That won't always be the case. Sometimes some units will be more than others depending on how the property is laid out. But for this example, I just want to assume each of them are $1,600. So a standard DSCR loan is going to have a 25% down payment. Are there DSCR options that require less down? Yes, of course. Some allow 20, some even allow down to 15%. The problem is the properties typically don't cash flow at those levels, and therefore, even if that loan exists, it's just not used because the properties rarely fit into those buckets. So 20 is possible, 25 is much more likely. Also, depending on the debt service coverage ratio of the specific property, you might end up needing to put more down to qualify. For example, and we're kind of getting ahead of ourselves here, if you put 20% down, typically that property's DSCR coverage ratio has to be 1 or higher. If you put 25% down, a lot of times they'll let you go down to a 0.75 threshold. Beneath the 0.75 DSCR coverage threshold, that becomes basically a no income DSCR loan, and they typically require 30% down for something like that. So just kind of keep that in mind. There's different options. The individual property will dictate which of these is feasible. But by and large, you should expect 25% down because that's what's most common. Now, in this example, means the loan amount is going to be $337,500. The interest rate, again, hypothetical rate. Don't take this as gospel because rates change throughout the day every day and would absolutely be different based on your circumstances, the properties, and then just time, okay? So that's going to make the PITIA $3,463. That stands for Principal, Interest, Taxes, and Insurance Association Dues. So what that means is when you take the monthly payment and then the sum of all of the different rental income from the different units, that means that your DSCR coverage ratio is 1.39% on this specific property. So essentially you take the rental income divided by the PITIA. That's how you get to that DSCR ratio. This is a very good cash flowing property. This will be an absolute yes as long as the borrower has the necessary credit score and the necessary funds for the down payment and reserves. So this is a great property as an example, and this investor would make a significant amount of money off of this over the long term. So you might be asking yourself, what does this cost? Well, it's actually pretty similar to traditional investment financing like you might get from Freddie Mac or Fannie Mae. There's basically 3 groups of cost: lender fees, title fees, and prepaid expenses. Now, the main difference with DSCR is that these typically do have a couple of points associated with them. And it's also not uncommon for there to be a prepayment penalty anywhere from 0 to 5 years, with 3 years being the most common. Yes, you can buy that prepayment penalty out, but like I said, 3 years is most common, and that's what you should expect as well. But you're going to have a slightly higher rate than you might get on a Freddie Mac Fannie Mae loan. And there's, like I said, going to be a couple of points, but at the end of the day, it's a very, very comparable product. The difference is if you go the Freddie Mac Fannie Mae route, you have to jump through all those qualifying hoops, and some investors might not be able to qualify for that. Whereas with the DSCR, it is actually very easy to qualify as long as you've got the necessary credit and you've got the necessary assets, and in this case, the property cash flows. So rough estimate to close, you've got your down payment, you've got your closing cost, and the sum of the cash to close is the culmination of down payment plus closing cost minus any credits there might be from the seller. I did mention reserves earlier. Typical reserves are about 6 months of the PITI. Whatever the monthly payment is times 6, that's what you need to have available in excess of your cash to close. So make no mistake, you don't have to apply it to the loan or put it extra down or anything like that. You just have to have the funds set aside just in case. So some DSCR lenders require 6 months, some require 12, some don't require any at all. You should plan for 6. It's never a good idea to put all of your liquid funds in any investment, much less a illiquid investment like a real estate property. So just keep in mind that DSCR loans are an incredible tool that real estate investors are using every day to build their portfolio. I would be honored to help. I help dozens and dozens of investors every year build their wealth with real estate, and I'm licensed in a number of states across the country. So if you are looking to build your portfolio or expand your portfolio, please reach out to me. Links are in the description. My team would be honored to help, and I appreciate it. If you like this video, please make sure to like and subscribe so that you can stay in touch with all the content I create, and hope to hear from you soon.